Dear CQA judges, we are UCSD Team 3. Here we present our investment methodology and strategy. These are my colleagues. This is our COO, Apollomic. This is our trader, Cheng Xi. I'm the head of research, Hong Ao. And this is another trader, Shan. And this is a researcher, Yu Chen. Here is our agenda, and we're going to talk about these things.
Our portfolio was formed in November 2019, and no rebalancing happened since then because we're using a quarterly rebalancing policy. The next rebalancing day would be March 1st, 2020. Our cumulative return is minus 1.82%. Excess return against the benchmark of S&P 500 ETF is disappointingly minus 11.3%, and the ranking is 23 out of 41. Slightly below the median. Our portfolio is beat by the market almost throughout 4 months, but beat the market by 10% between November 28, 2019 and December 4, 2019. The main reason for our loss is attributed to roaring tech stocks that we short and unexpected coronavirus outbreak that saved some medical stocks we short. We will cover this in the later stage. Our investment philosophy is to invest in good business rather than to speculate. We use less popular and less academia coverage criteria to select stocks, so that we're not just testing old theories that have been justified 1,000 times in thousands of papers. But our criteria also have to be economically intuitive. Our strategy decomposes the value of a stock into 2 dimensions. One is financial strength of the company. The other is investors' confidence towards it. We further decompose the investors' confidence into insiders' confidence and outsiders' confidence. We believe Piotrowski score is a good criterion that can be used solely to capture a company's financial strength, because it covers almost every dimension of a company's financial position and summarized in an equally weighted way. The only caveat is that most early-stage companies are currently losing money and are growing very fast, which implies that using Piotrowski score may reduce our exposure to the traditional risk factor growth. The rest of the criteria are inside buying and short interest ratio. Inside buying represents insiders' confidence towards the company, and short interest ratio represents the confidence of general market participants. To make them robust, we have several assumptions. Our assumption for inside buying is that insiders have better insights on a company than the general public and outside analysts, and insiders buy shares only for expected higher return. We notice that in real world, inside buying usually have more complicated implications and motivations, which we will continue discovering in the future. Our assumption towards short interest ratio is that motivation to short only includes making speculative profit. In real world, short may also be used in hedging or other risk management strategy, which has nothing to do with confidence. We also assume that trading volume of a stock is relatively stable in the short run, which implies that the volatility of short interest ratio mainly comes from the change of short interests.
With our criteria determined, we use technical analysis on Bloomberg as a tool to form our long and short portfolios. To start, we narrowed our investment universe of the Russell 1000 index. Next, we applied the criteria Piotrowski score, short interest ratio, and insider buying to execute. We bought 89 stocks with high Piotrowski score, more than 8 in the past 5 years, because we believe that companies with strong financial strengths tend to have a good performance in our portfolio. The Sharpe ratio of this loan portfolio was 0.45, which showed a good balance between returns and risks during these 5 years. Another loan strategy is to buy the stocks with high insider buying volume as a percentage of total volume, and we set the benchmark to be 0.01 for the previous 5 years, we assume that the insiders have better oversights, and insider buying indicates stocks with great potential. Using this strategy, we generated another loan portfolio with 25 stocks having a Sharpe ratio of 0.79. In the converse strategy, we want to filter out stocks with weak financial performance, so we shorted 79 stocks with Piotrowski score less than 2 for the past 5 years. Now we have introduced our process to generate portfolios. The next step was to backtest our strategy. To do so, we applied our methodology to Russell 1000 index across time in order to consistently compare the performance of our portfolio with the market. We first applied the strategy with Piotrowski score over 8 to test returns over 5 years. The result was a total return of 49.52%, a mean return of 9.67%, and a standard deviation of 12.89. The Sharpe ratio of this portfolio is 0.47. Conversely, our short strategy with low Piotrowski score was tested to have a minus 0.67 Sharpe ratio. To be specific, the total return was minus 19.8%. The mean return was minus 16.66%, and the standard deviation was 18.23.
Our short interest ratio strategy got a minus 14.56% total return, minus 1.41% mean return, and 15.78 deviation. The implied Sharpe ratio for this short portfolio is minus 0.11.
Another factor we chose to pick our stocks was insider buying ratio. We used an insider buying ratio of greater than 0.01 over 5 years. We backtested the same and found that the Sharpe ratio and the total return were much higher than the average return of the S&P over the same period. Insider buying ratio represents the number of shares bought by insiders, promoters, and management of the company, which we believe is a good indication of a stable company with good prospects and a good business model.
Here's the overview of our portfolio's absolute return outperformance from execution on November through February. Diving more deeply into the driving force behind active return, the growth, size, media play important roles. The rest are market intercept and food products. On the other side, the bottom 5 contributors are automobiles, profitability, liquidity, earnings yield, and energy industry. Taking a closer look at our portfolio, we can see that our top holdings are dominated by long, while our bottom holdings are typically short positions, which we attribute to the recent struggles in the market. The highest percentage return is up to 51%. As for the bottom 10 holdings, we attribute part of poor returns in our long portfolio to the broader market struggling, as well as an identification of strong short opportunities with our methodology. Specifically, as large amounts of new shares ending lock-up period, Uber underperforms with weak earnings model.
For the last part, let's move on to conclusion and takeaways. We learned that outperformance in backtesting doesn't necessarily lead to outperformance in the future. The most important takeaway is that we have to stay alert all the time and respond to major market events as soon as possible. Thank you for watching.